Hello and welcome to Uniper's Market Insights, a special edition today because Gregor and I will discuss the topic trading. And it's something that is close to my heart because, back in 2008 I helped to relocate the trading business here to Düsseldorf, traded myself a little bit, and now I'm able to report on it and do the show with you, for example. So
happy to do so.
Without the trading, it wouldn't be Gregor and Florian.
Absolutely.
So, good deal. Now, what we want to do today is explain a little bit in detail to the people out there what is behind the topic trading. So, I think we could start with what does our audience have to do with energy trading at all?
Yeah, a lot, because everybody's got their bills for electricity and gas at home. And the price is, of course, defined by a supplier, but this supplier very likely buys on the wholesale market or on the exchange or bilaterally. So the price in the markets, as the colleagues trade here, is very relevant for the price everybody finds on their bills at home.
And why are people doing this? Why are they trading?
There's a variety of reasons. So first of all, there are people who trade for profit, but that's actually only a small part. So what happens here is that when a customer buys electricity or gas or oil or coal, it's basically the same. For example, they want to either deliver to their customers or they want to use the gas and the power for their business, like an industrial side. Yeah? So they also buy from the markets, and for them, it's a reduction of risk. So, for example, if you produce certain goods and you want to know what's your price for the energy 3 years out, because you need that to produce your goods and you need it to determine the price for your products, it's a good idea then to buy the energy at a predetermined price at those markets, because it simply helps you to reduce the risk of the price of energy. So that helps you to run your business. And it's also called hedging. So this is what many businesses do.
Okay, and that is more the physical side of the business, obviously. There's also the financial side of it, financial trading. What is the difference there?
Yeah, so there are products that are meant for physical delivery, which means the delivery comes, the buyer delivers the electricity, the seller takes it physically at that point. There's nominations in the respective systems for gas or for power. But there are also other products that we say settle financially, which means then you buy at a certain predetermined price, and then there at the end of the day, when it comes to delivery, there is a difference between that price and the market price at that point in time, and the difference is then either paid or you receive it, and that's a purely financial settlement. That is useful if you just want to manage financial risks and you don't need the electricity at that point in time.
Understood. And where can people trade electricity or gas or?
Well, there are various trading points across Europe. There are exchanges, but also people trade also bilaterally at certain trading points. So there's, for example, the European Energy Exchange, which is one of the most important exchanges in Europe for electricity. For gas, for example, we have also ICE, intercontinental exchanges. For power, also Nasdaq in the Nordic region. So there's a variety of both exchanges and trading points where people can also decide to interact bilaterally.
Okay, and you already mentioned it slightly. Is there any more specific behind the trading of gas or LNG, for example?
Yeah, gas in Europe is a very, as we say, very liquid trading, which means you can almost always find a buyer or a seller, at least for up to 3 years out. And it's traded at very liquid points, for example, in the UK at the national balancing point, or in the Netherlands, which is the most important gas trading place in Europe, the so-called TTF, which we often spoke about here in this format. And also in Germany, places like the THE is where gas is traded. But then gas is also a global market. So you can use ships to take liquid natural gas, for example, from the US to Europe. That happens a lot. And then you can trade the capacity of these ships, the charter for this ship. And you can buy it in the US at the price there. So a marker price is the so-called Henry Hub price in the United States. And you can deliver it to Europe and basically sell it for example, at the TTF. And you can trade all these components on a global scale, and this makes LNG trade so special.
Yeah, very dynamic market for sure.
Very dynamic, yeah.
Yes. So the customers at home, they usually get a bill once a year, and then you can sign up for another year or two where you have a certain fixed price. What kind of contracts are traded on the energy side?
Yeah, everything. You can trade years, you can trade months. So typically a company that would sell the energy to you, your gas to you at a, let's say, 2 years contract with a fixed price would then try to buy this energy at the wholesale market for a price that guarantees them a certain profit against the sales contract they have with you. So that is on the forward market. But then also what is very exciting in particular in power is the short-term markets where, for example, producers of energy sell their energy effectively in 15-minute intervals as we speak. So that is very useful if you have output of renewable energies where wind and sun change the production of energy, and you can either sell the surplus or buy. If you have sold something and you don't have enough, you can very quickly buy that back for the market. It's actually very exciting because it's very high frequency.
Yeah. Understood. Yeah, and I remember, of course, it depends a little bit on how risk adverse you are as well, because the further out prices are, the more uncertain the events are and the prices. And of course, the closer you are, more certain about it. Weather plays one big role, and this is one of the reasons why we have a team of meteorologists here on site as well, also on this floor, also important. And that's what my next question would be, because you can actually trade weather as well.
Absolutely, yeah. It sounds exotic, but what you can do, you can trade degree days. That's the difference between a certain reference temperature and then the actual temperature. So which is clearly a measure how warm or how cold it is. And if you add that up over a whole month or a whole heating period, it's a measure of how cold or warm it was as compared to a certain reference temperature in this period of time. You can use that to basically, for example, get financial compensation if your business isn't doing well. So if your business is selling gas and you sell less because it's warm, you can decide to use a degree day product to basically at least compensate you for the loss you make or the lack of profit you make when it's warmer than expected, or the other way around. So there are these possibilities.
Yeah, very interesting topic, especially in times like now where it's really going up and down temperature-wise, and especially when we look at storage situations and stuff like that. Not something that needs to be ignored or something that's really relevant for sure. But something that goes through the trading business as well is always risk management. It's highly important. And I remember when I met with my customers in the UK, it was always the first question, like, how much risk do you want to take over a certain amount of time? Because that kind of dictates the hedging strategy. How would you grade the importance of risk assessment in this business?
Yeah, it's extremely important, because when you run a business, you need to be prepared to take certain risks, but you also want to know which risks you take. And risk management tells you exactly that. So we talked about market risk, but that's only one risk you have in trading. Another risk is credit risk. So if you buy or sell energy to a customer, that customer could be bankrupt before they pay the bill. So this is credit risk, and you have to manage that. You have to be aware what these risks are, and you have to reduce them, limit them, so your business is not at risk when, for example, a customer can't pay their bill. Other risks are liquidity risks, so the cash you have in your company, in your pocket. There's, for example, a very efficient way to manage your market risks when you sell or buy at an exchange, where that price is then guaranteed. And if someone drops off and can't deliver what they've sold at the energy, that energy is then bought by the exchange. And in order to guarantee that, everybody who trades at the exchange has to put in, we call it collateral, as in cash, if you want a guarantee that your delivery can be replaced in case you drop out. But you need cash to do that. And so what you see is that there is a clear relationship between market price risk, credit risk, and liquidity risks. And it's one of the most important tasks of risk management to balance all these risks.
Yeah, especially if prices are really, really high. Of course, collateral gets higher as well, and you really need to focus on the cash flow there. For sure. Yeah, I mean, it's one of the biggest areas within Uniper as well. And that's it's a very important.
It's extremely important.
Yeah, definitely. Gregor, that was it already. I hope we could, explain a little bit more in detail what trading is all about. And if not, to you out there, please drop a question under this video. Thank you very much for sharing your insights, and see you in the next episode then. And to you out there, thank you very much for watching or listening. See you next time. Until then, bye-bye.